Hey, thank you for tuning in. Thank you for subscribing. I thought I'd look at the production numbers this week. Uh, looking just at the weekly numbers, we saw production go down a little bit in July and August, and now they've seemed to bounce back quite a bit here in September. So I thought I'd go back and look at some of the details we have about some of the tight oil production, some of the Permian production, and see what's really going on. There's actually some surprising numbers that you can tease out from this data set that we have. Hey, I'm Aaron with 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil market. So let's get into it. All right, here's a presentation for this week. If you remember, I've got a special deal going as a thank you for getting to 1,000 subscribers. We're at just over 1,070 subscribers, I believe, at this point. So thank you very much for getting me past that milestone. We need to keep growing the channel. We need to keep having new subscribers come in. But for the time being, for sort of this week only, by the end of September, I'm going to raise prices back up. We're offering you really cheap rates on this Elevate Your Understanding subscription. And so typically what I do is I take that Elevate Your Understanding document and I sort of pull little bits and pieces from it to make this video, this type of video that you're watching now. So that Elevate report is the sort of thing that we'd have on the trading desk when I was at the banks. The sort of report I would generate for the traders and for myself that would sit next to you on the trading desk where you're trying to make these decisions. You'd have that source of information that you could go to right there and flip through the pages. What's diesel demand doing? Where's gasoline inventories? What's Cushing crude stocks doing? You'd have that right there at your fingertips and could flip through it. So this is actual institutional grade, high quality information that can be yours for $25 a month. If you go now to our website, and again, I've got sort of a clip of the screen here, but again, this is a super great price. It's going back up at the end of the month, but I just wanted to remind you about that here. So anyway, getting on to the more interesting stuff here in the market. This week we had a very, I would say, heavy settle on Friday. Monday and Tuesday, again, the market, WTI was going up and up. Again, a lot of headlines out there that were seemingly bullish. And, as you kind of dig through them a little bit, maybe not quite as much. But by Friday, it all kind of crashed down on a heavy note. Now, we do need to note, especially if you can see here the volume indications at the bottom, it's a little bit, I don't want to say misleading. It is what it is. But keep in mind that October WTI goes off the board on Monday. So we're recording this on the 19th of September. On Monday, the, what would that be, 22nd? The October futures go off the board, so it makes sense that the volume would be a little bit lighter as people are cautious. They, either would have rolled that October position forward and let people who are actually going to, deal with actual barrels at Cushing, Oklahoma, keep their length or their positions going into expiration like that. So it's not completely unusual to have volume a little bit weak going into expiration, but it is something I sort of do want to flag there. We were unable this week to get back to that 20-week moving average. Again, this is a weekly chart. I like to sort of zoom out and look at the bigger picture. Even if you're going to be trading, in for just a few minutes or 15-minute sections, I like trading off a 15-minute chart as well. I think it's super handy to take a bigger picture, take a bigger look at what's going on these sorts of weekly reports, so you can kind of readjust yourself if you need to and not get caught up in the minute-to-minute minutia of the market. So that's why I present it this way as a weekly chart. So at any rate, we failed to get up to that 20-week moving average, the center of the Bollinger Band, but we also failed to test the support line this week, which we had tested for the last couple of weeks. It's been about 3 weeks since we had failed to test that support line as well. So in my mind, there's some consolidation going on here, maybe some uncertainty about what's going to happen. Maybe you're on the right track saying there's lots of bullish headlines over the past 2 weeks, but the market hasn't been able to capitalize on that. Hasn't been able to hold any rallies on those bullish news. Again, I would argue that some of the actual news coming out of the market is probably a little bit more bearish, like Saudi trying to plow more barrels into China and that kind of thing. So it'd be bearish anyway from a U.S. perspective, as that might squeeze out some of our barrels or some of the competition for our barrels anyway. So it made sense to me that the market came off the highs on those headlines. Well, obviously, last week we ended up a little bit week on week. So I think it's interesting. It feels like some consolidation here to me. I still think there's an opportunity to go down here over the next maybe 5 weeks or so, just as we get into the shoulder period, as demand cools off a little bit. The winter weather hasn't set in, that sort of thing. It looks like, maybe I'm speaking too soon, but it looks like hurricane season, as far as the Gulf is concerned, is a non-event this year. Hopefully that remains the case. So maybe give us a little bit of a breather from a pricing perspective. I think that, again, would be a great buying opportunity if we did get back down here, especially for something for next year, a little bit longer dated. At any rate, like I said, I was looking at production this week, and primarily I was looking at tight oil production, and even within tight oil production, looking at the Permian, because that is so centered around, Permian producers are so centered around what WTI prices are doing. Gulf of Mexico, which is the screenliner Gulf of America production, there's really long lead times for that stuff. It's not quite as sensitive to what's going on in the front of the market, although they're certainly taking that into consideration. It's the smaller independent tight oil producers that are really watching what's going on in the WTI markets, in the futures markets, and in the different basis markets to get an idea of whether or not they should go out and sink some more holes in the ground and find some more oil and bring it back. The turnaround times are getting, for a while there, when things were good, when we were in a high price environment, turnaround times could be pretty quick, especially to some of this acreage that was already sort of linked up to takeaway capacity and that sort of thing. So you could see an indication to, a good price indication for these guys. And then 3 months later, you'd see production start to come online. So if you recall, back in June, we had the Israel and Iran going at it, and prices spiked up pretty high at that time. And you can probably go back and find those older videos, and it would certainly be in the older Elevate reports too. But I showed how open interest on like Cal 26 really spiked up. So you got to good hedging levels. There's a lot of hedging activity going on. I verified with friends in the industry that, yeah, they saw a lot of producer hedging at that time too. So I think we're kind of waiting for that shoe to drop now. Again, it's not 100% guaranteed given the price direction that we have now. If the hedging went on, it may have been just to hedge the programs that were already sort of in place and not to add anything new. But again, I'm still sort of waiting. I'm still hopeful for now anyway, that we will get some production here at the end of Q3, maybe beginning of Q4, that we can trace back to that June spike. So at any rate, I was looking at the numbers, especially for the Permian. I've got some notes here just off to the side. Hopefully that's not distracting to you. But so just a few things I wanted to throw at you. The July and the August numbers are basically flat for the Permian. On the August numbers, I'm a little bit skeptical just because that's the most recent data point. They do go back and they will change this as information comes in, especially, Texas makes up the majority of the Permian. Texas Railroad Commission is the one responsible for reporting this sort of information, and they're not too good at doing that in real time. It takes them a little bit of time to get caught up with some of the paperwork load. I'm not sure exactly what the bottleneck is, but in other words, I wouldn't exactly trust maybe the two most recent, especially the most recent data point being August right now. So let's give that some time. So August versus July was basically flat. July versus June was up 9,000 barrels per day, so almost flat. And then if you want to look at so now you're getting back to where I think the data is starting to be, I'm more comfortable relying on that data. June versus May was up 19,000 barrels per day, which is exactly where it was the same time last year. So June 24 versus May 24, we're also up 19,000 barrels per day in the Permian. So this year for the month of June, that would put us at 5.64 million barrels per day. So that's super healthy. Outside of Saudi and Russia, that's going to be your biggest OPEC plus producer by a lot, right? Iraq is what, 4.6 in that neighborhood. So a million barrels per day more than what Iraq puts out. So I mean that's a lot of crude oil, right? That's coming out of the Permian. And I guess again it depends how you want to break this down. So if you want to look at just the June versus January, so the first half of the year, I think that's a pretty good comparison. This year production was up 4.5%. Again, from June versus January. Last year we were up 5.6%. The year before that, we were only up 0.7% in 2023. There has been some, I guess, more than normal, more than I would have expected, or they're maybe becoming more frequent. We have these freeze-offs in the Permian in either January or February that are starting to sort of maybe stand out more in the data to me, I guess, maybe since I'm digging through this. So last year in 2024, we lost 257,000 barrels per day in the month of January versus the previous December. And we got that, most of it right back in February, up 206,000 barrels per day. So a big recovery there. This year, though, was a little bit different. This year was interesting. So in January of 2025, Permian production was down 173,000 barrels per day versus the previous December. But then in February, we were up only 85,000 barrels per day. And then in March, we were up 105,000 barrels per day. So it basically took us 2 months to get back to what we originally lost in the month of January. So that I thought that was pretty interesting there. The other thing I want to sort of point out real quick, again, we just said that June was the month when prices really took off. So keep that in the back of your mind for one moment. And we said that June versus May of this year was up 19,000 barrels per day. The exact same number as it was in 2024, 24 June versus 2024 May. Now, the important thing I want to point out to you is that prices in the first half of 2024 were closer to $80 on average. So I broke it down by quarter. And if I come over here, I can tell you. So in Q1 of 2024, WTI spot price averaged $77.50. In Q2, it averaged $81.81. So we can say in that first half, we averaged just under $80 at $79.65. For Q1 of this year of 2025, prices averaged $71.73. So we're already down $6 versus Q1 2024. And then Q2 was only $64.57 versus $81.80 in 2024. So the first half of this year, we're looking at an average of $68. So you're looking at $11 and $12 decrease in value for, that's what producers are looking at, right, at making these decisions. But at the same time, production this year was up 4.5% versus 5.6% last year. And again, a lot of that came because of that interesting Q1 freeze off or January freeze off. I think kind of set us back, and that's where a lot of the deficiencies came from. And what I mean by that is if we look at just this period of time, say March through June, production's actually up year on year. So this year, March through June, so we're sort of setting aside any freezing events in Jan and Feb and saying those happen, but let's kind of start in March, where typically that's when you almost always see production growth in the month of March. So let's start there instead of looking at these winter months and going to June, which again, as far as I'm concerned, is the last number that I'm comfortable using to put any sorts of analysis on there. At any rate, March through June of this year, we're up 161,000 barrels per day. Same time last year, up only 89,000 barrels per day. Put it in context, back in 2022, up 242,000 barrels per day. So year on year, we're actually doing better, almost double, but not quite. Um, what we did last year in that time period, March through June, but prices are $10 to $12 lower. So I found that's super interesting. The other thing that's super interesting to me anyway is that over the long haul, so going back to 2008 when tight oil sort of first started, which hopefully you can see. Um, there we go. Hopefully you can see on the chart here, tight oil was just in its infancy back in 2008. But at any rate, just looking again at the Permian part of this, the production really grows in the second half. So going back to 2008, Jan through June time period, typically up 9%. So if you look at the June number versus January number, on average, you're up 9%, through that time period, 2025 back to 2008. But in the second half of the year, you're up 12.9%. So this time we're looking at 2008 through 2024. Since, again, in my mind, we don't have reliable data yet in the second half of the year. So there's still a decent chance of getting some production growth in the second half of the year. If we don't get that production growth, I think that's important information for us as well. Of course, not, every year we didn't. Last year, production grew in the first half of the year, like I said, 5.6%. In the second half of the year, it only grew 0.9%, so less than 1% in the second half of the year. So it's not a hard and fast rule that second half grows more than first half. It's just on average, going back to 2008, that's what we've seen. So take that for what it's worth. I'm going to be closely watching these production numbers coming out over the next few months, especially the monthly reports that gives us total production, and then especially these tight oil reports that the DOE does as well. So anyway, I found that very interesting. I hope you find that interesting as well. The producers are holding up at least through June better than I thought they would anyway. But if you look at price, so here's again that price spike I spoke about. The blue line is WTI, the orange line is natural gas. So the blue line, we're going off the left-hand side of the chart here, spiked up mid 70s, came right back down fairly quickly. This is Friday versus Friday settlements, or just the Friday settlement, sorry. The actual outright number, not versus anything. So we spiked up to the mid 70s, then came back pretty hard, back into the mid to low 60s, and kind of been grinding lower since then. Maybe found some support again in the low 60s for the time being. Natural gas did a similar thing, but I think for probably different reasons. Got up here, $3.75 or so, and has come down below the $3 mark, which again should give us, somewhere between $3 and $2.75. Should give us a little bit of pause for producers. Again, it's sort of like in crude oil, we're not at the most comfortable level for crude producers. It's not a clear decision to go out and just develop and develop and develop. Producers for both natural gas and for crude oil at these price environments need to be really intentional. They need to probably be focused on what they can get quick returns on. Again, looking for acreage that is already hooked up to infrastructure. They can get stuff out of there very quickly. Basically, the low-hanging fruit. And obviously, the longer we spend time down here at these low prices, the more of that low-hanging fruit they're going to pick, and the less there's going to be. And things have to change at that point. So, of course, there's efficiency gains and all sorts of things that can come into play, as they seem to do, especially in the Permian. Where people are very inventive and innovative and can figure a lot of interesting things out. So, again, the point is I'm trying to make here is we had these really good numbers back in June. Now, recently, meaning in the last month or so, gotten again to these places where, it's a little bit uncomfortable for the producers here. But there seems to be a bright spot in that place sort of in between oil and gas producers. There's what we call NGLs, or natural gas liquids. typically they're talked about in terms of the natural gas. So you talk about maybe a wet gas play, if you've ever heard that term before. They're talking about methane plus production coming out of there. Strictly speaking, the NGLs are going to be ethane, propane, your butanes, C5 or natural gasoline or condensate if it's a little bit heavier. The problem is there's lots of different words to describe these same things, especially when you get to C5, the condensate, the natural gasoline, that sort of thing. But what you can do, though, is you can take the value, and we know, again, back looking at the monthly reports, monthly production reports, we can figure out how much of each of these component parts of the NGLs was produced, and then go back and get a weighted average value for those. And what the market does, again, typically is looks at that versus natural gas. So that's what this frac spread is right here. It's a weighted average of the various NGL components put together and divided through by their relative production numbers, right? So I believe ethane's something like 46% around there, 41 to 46% of the total NGL field production number, et cetera, et cetera. And you subtract that from gasoline. So it's sort of similar to saying you extract gasoline and diesel from crude oil, and therefore the refining value is this when you take the parts and you subtract it from the original feedstock, the crude oil. In this case, we're taking the parts of wet gas and subtracting it from the dry gas or the methane or the natural gas number at Henry Hub and coming up with a frac spread value. The big catch, at least in my mind, since I'm an oil guy, is now we're pricing stuff in dollars per MMBTU per million of British thermal units. And that always gives me, I have to like sit down and actually focus there for a minute to go back and forth between MMBTUs and barrels, dollars per barrel. So at any rate, the point is that you are actually getting an increasing frac spread over time, especially if you remember, the June spike in natural gas prices at Henry Hub have been going down. Let's see if I can go back. So the thing we're subtracting from has definitely been going down over that same time. But the NGL values have been holding up pretty well during that whole time. So now you're seeing, and maybe it's a little bit better return. You're not going to market your entire drilling operation around extracting NGLs, but it is kind of a nice, little bonus for these guys to see, hey, actually your frac values are actually doing pretty well, even though inventories are swelling. So one thing I found interesting is, starting this in May is about when we started to see inventories go above year ago levels. And even though we've been consistently above year ago levels, and now we're at an all-time high at 300 million barrels for total NGL inventories in the U.S., we've seen frac values increase that whole time. So again, there's little bits of silver lining, I guess you can say, from a producer's standpoint in these sort of things. So just, I guess, one more thing to keep in mind. If you guys are trading the equities or you're looking at producer names and that sort of thing, to keep that in the back of your mind. And then final thing on this week's video is retail prices. So as I mentioned, they've been super steady all year. I mean, diesel had this little spike here where we had prices go up about 8 cents over 2 or 3 weeks. I mean, in the long run, 8 cents probably is not going to disrupt your operation too much, especially if it's just, I can see maybe if it's something commercial and margins are super tight, but just from your average consumer standpoint, 8 cents per gallon is probably not going to make a huge difference in your demand, if you will. You're not going to change your business plans based on 8 cents a gallon. Gasoline's been super stable this year. Economists, people like me, the government, in terms of looking at inflation and that sort of thing, will look at it more in this view, sort of in a year-on-year comparison, which again is a little bit silly because I don't go to the pump and think, oh, am I going to fill up my car today or only put 20 bucks in? What were prices doing this time last year? Make the decision based on that. Of course, when inflation is up, there's more things to spend those $20 on or whatever. And so maybe you do it a little bit subconsciously, but you're probably not thinking, well, what were prices this time last year? But certain sectors of maybe the academic world, if you will, want to think about it that way. So year on year, we actually saw some really good declines because prices were so high previously. And like I said, we've been relatively stable so far this year. So it's more stability this year and prices swinging around um, in last year. I am a little bit concerned about diesel prices, though, going above year ago levels. Maybe not quite yet in terms of the actual increase or the percentage increase. Usually we look at 20% year on year increase as the level where people that does start to come into your thinking. Again, especially from a commercial standpoint, if you're trucking things all over the country or super sensitive to diesel prices, a 20% year on year increase is where we start statistically is where we start to see some demand destruction come in. Obviously, we're nowhere close to that, but I do have a little bit of frustration in diesel prices staying relatively high, trying to go up week on week when they should arguably be going down. So hopefully, pretty soon here they will go down. I just kind of wanted to flag this to you. Again, gasoline prices should go down here pretty soon as well with the RVP change, the seasonal change that comes up every year. It's just you can basically add more butane to the gasoline pool is what the very short answer to that question would be. So, yeah, I think retail prices should be coming down soon. I'm watching these diesel prices closely. Um, they are starting to look a little bit high on the retail level, at least for now. So that sort of sums up what I wanted to share with you in this video. Again, if you go to our website, theoilbalance.com, and you subscribe to our Elevate report at that special price, you will get much more information about these things, a lot more charts, a lot more details, detailed explanations and whatnot about what's going on and how we're viewing that and how it sort of fits into the main themes that we're seeing for this year and starting to see for next year. So again, thank you for watching. Please like and subscribe and visit our website, theoilbalance.com. Thank you.